Deep dive on implied volatility. In Sell the News, we do bear call spreads, which is a credit spread bringing capital. Unlike a bear put debit spread would cost us something. One of the main factors between the two is volatility. We all know that the IV level plays a crucial role in the pricing of options. When the IV is relatively high, options tend to be expensive. So if we sell those expensive options, that brings in a premium that we're collecting, hence the word credit. When IV is relatively low, option prices tend to be cheap. And sometimes this is a trap. And the reason it's a trap is just because it's low doesn't mean it can't go lower. Or for the flip side, just because it's high doesn't mean that it can't go higher. One of the rules we like to use is the current percentile or implied volatility. If the current IV percentile is up near 50, then you would want to sell calls to collect the premium. Or if implied volatility was up near 75 or 80, that would identify selling calls as a better trade. If the current IV percentile is at 10%, then buy and bear put spreads would be good. Or even an implied volatility of 25% or less. We all know when doing a bear call credit spread that the best thing is price go down along with implied volatility. And of course, we're going to collect that time decay. So there's 3 different categories that make up the profit of your option: price movement, implied volatility going up or down, and time decay. So let's say the price movement works out just fine, and we hone in on the last 2. If we see that implied volatility is low, and we buy a put spread, hoping that the implied volatility goes up, which in this case it does, we would still lose time decay. So for this example, we got 2 of the 3 considering that we bought a put spread because we saw low IV. Now, if we saw low IV and we bought a put spread, but really the IV was up here and we didn't recognize it, and the IV sold off, that would take some of our premium from the profit. And time decay would have eroded away, also taking profit away from us. Meaning now I have 2 potential things taking away the reward of the trade, even though price went in the right direction. Now let's consider if we did a bear call spread, even with low IV. Price goes down, we sell implied volatility right here, and it goes against us, so we lose out on this portion of the options. But since we sold, we still collect that time decay. So now we collect this regardless. This is the guarantee portion of selling time decay. So in this scenario, we would have got 2 of the 3 potential profit zones. So if I had to guess, will implied volatility absolutely fall off? There's no guarantee. Will time decay fall off? There's 100% guarantee there. And the only way I get this is if I sell bear call spreads. And I get it because the IV behavior on low IV trades has much smaller spreads, better ROIs, and it has better break-evens. Versus the high implied volatilities, the spreads are bigger, the ROIs are worse, and the break-even has a bigger percentage away from the price. Now, if we take this a little bit deeper, implied volatility measures the reflection of the likely price movement in the future. It does this by calculating the derivative price model. Remember the standard deviation? It's also used as finding the future price and volatility on price action. What do I mean by that? The higher the option's implied volatility is, the higher the price is to have a bigger move on the underlying stock. Now, this is a big rule. IV does not predict the direction of the move, just the magnitude of probability. Have you ever seen a probability cone? A probability cone is used in options to show the likelihood of being in the money or out of the money based on a range. Standard deviation again. Remember, the standard deviation is 68.27. And they believe so much in this standard deviation that they're predicting where the movement of this stock will be. And the time of year that we see the biggest increase in volatility is right before earnings. Option makers don't know if price is going to go up or down. So regardless, for them to make money, they just raise the implied volatility, making you pay more premium. So if here's the normal price it should be, and they're inflating it all the way up to here, that means all of this is extra profit in their pocket. What do I mean by that? Well, look how much they sold that value back down with the implied volatility. And again, and then look how sharp this is. Straight down, value lost. And why? Because price didn't even move that much in here. Although price moved a lot here, they already made their reward on the implied volatility. So they have to let it go lower to collect that premium. Think about this. If implied volatility went up from here instead of selling off as this price went up, then option makers have to make up the difference of this increase when paying back out. But if they collapse it, then they save money. So as a rule, when you see high implied volatility, know that greed is going to follow and it's going to sell off after that. It's not an indication that price is going to go up, even though it did 3 out of the 4 times. It just means there's extra money on the table to be taken as this premium comes down for us to make. Now let's put all the pieces together. Remember when they said low implied volatility means low price movement? And so as you can see, for the last 3 months, this thing's under 1.8, meaning not much of a price prediction in movement. On some of the bigger days, we had 1% moves, but on the smaller days, like 0.5%. And that's pretty typical on ETFs. You can see there's no dividends, no earnings. And think about what we said before with IV. It always comes up and then immediately goes down so they can collect that premium. Look at these big spikes. But it doesn't always translate in big moves in price. And remember, all of these areas are around 0.3, not even at the 0.5 mark. So when looking at XLP, right now at $72, going out 1 month, for easy math, we'll call it $75 minus $69, giving us a $6 spread. On $72, easy math, let's just say, they're expecting the price to stay in a 10% range. No matter if it came out a little bit, by this time period, the price would be in between these two lines. One standard deviation says 10%. And remember, that's on an ETF with a very low implied volatility of 1.3. Let's look at SkyT. You can see there was no implied volatility. It just started. And technically, this is an IPO. So volatility is at a premium 1.0. And remember what we saw under 0.5 was low implied volatility, and this is starting at 0.6. So this is an extreme. Same probability cone starting at $27. Right here's the September 25th. Our high price is $35. Our low price is $18. Now before, this was about a 10% spread from the price. What do you think it is this time? Did you say 17? Which is crazy considering we're only at $27. That's almost a 50% price movement, meaning they're not really sure where price is going to be, but they think it could be very volatile 1 month from now. So now let's compare the last couple moves. This move was 34%. This move was 50%. And just today it moved 30%. So we see that stocks coming into resistance that are big movers have a likelihood of selling off quickly, giving us our profits quickly, versus being in something with low volatility, giving us a 4% move over 18 days. That's not very good. And we've noticed the biggest and best gains with the highest implied volatilities. Over 1% has always been good to us. Even we've had some quirkiness of implied volatility going up here, we've still made our profits. Implied volatility was 1.3, kept going higher, and we made all our profit. Kept going higher, we sold calls and made our profit. Made our money with implied volatility being over 1. Over 1, made our money. So I definitely think we need to stick to the 0.8 or higher, maybe even always over 1, because it consistently gives us bigger moves. It's not a guarantee because we had implied volatility sell off, but price kept going higher. There's no perfect system, and that's why we doubled down. And don't worry, we're coming into resistance again. Maybe creating a wedge pattern. Here's another one. Price came into resistance. Price sold off. Implied volatility sold off. Perfect trade. Now we came up into resistance. Implied volatility sold off. And price kept going higher. Same exact trade, just different results. So we doubled down because we're still up against resistance. But obviously, I like the trade better with the higher implied volatility than way down here. But regardless that the implied volatility was low, I still sold bear call spreads because this is good. But before, implied volatility was way up here and now it's here. But there's no guarantee that implied volatility is going to go up from here. It can still sell off more. But this thing here is a guarantee, which will be a great for a double whammy if we can get price to sell off also. 2 of these categories out of 3 will still reward you the profit you want to see on each of these trades. And I hope that helped on implied volatility.